Hello and welcome to your Monday Futures Market Outlook for April 9th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out eMoneySource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index futures, here we were suggesting that while we believe that the US dollar could consolidate back to its lows, and in fact a much more bullish US dollar scenario is still very much in the cards from our technical perspective. At this stage, we saw a very nice bottom the other week and subsequent reversal higher. At this stage, we are going to be watching to see if the US dollar here could follow through back up to the top end of the range, since it's coming from the bottom end of the range. If we, for whatever reason, see a breakout above that 81 level where those highs came in early March, and see any follow through up toward 82, that would certainly give us an indication that the US dollar could potentially do a key breakout. Now we'll probably see even a rally go up to 84, 85 on the upside. Again, we can initially speculate on that upside move, and we certainly could take some initial trades, but the most important thing will be a little bit of follow through off of last week's strength to indicate that that money is flowing into this US dollar as a trade. A lot of that US dollar strength is coming from the euro, so I want to take a look at that euro FX futures, and you can see how it was almost like this little head and shoulders pattern developed between February, March, and April. We're now sort of trading right toward a very important neckline around the 130 level on that euro. This is a crucial stage because if the euro begins any aggressive selling below 130, not only would the January lows of 127 be in the cards, but we could be looking for even a much more sustained drop in the euro that could even see not only 125 but maybe even 122 or 120 on the downside. Now it's a pretty big picture forecast, but that would certainly be what fuels the US dollar rally that we were just talking about in the previous slides. So we're going to be watching very carefully what the euro does at this very level. Again, we haven't seen the break yet, so we can't become euro bearish yet, but any break of this 130 level on the downside certainly could be the signal that opens the floodgate for some more sustained euro selling. Next here, I want to take a look at that 30-year Treasury bond, and this was a very interesting pattern. We had initially a breakdown on the Fed minutes last week, but then the Treasury bond started being accumulated very aggressively almost immediately the day after. At this stage, with us now having traded all the way back to this critical 140, 141 level, it is this is a make it or break it level for the Treasury bond bulls. If we can see a really good kick above this support resistance level on the upside, it would certainly, at least on the short term, indicate an intermediate, short term to intermediate bottom is put in treasuries, and we could therefore start looking for even treasuries to rally back to their previous highs around that 145, 147 level on the upside. So let's watch whether or not the bulls can beat the zone this week. Next year, I want to take a look at copper futures, and copper has continuously banged its head on the overhead resistance level at the $3.90 to $4 level. And really at this stage, we're now trading right to the neckline point of a potential breakdown move. This certainly would correspond with US dollar strength. There's a natural inverse relationship of commodities to the dollar. So if we see a euro breakdown and a US dollar rally, then it certainly would allow many of these commodities to begin some distribution or selling. And so let's watch whether or not this follows through, and particularly more importantly, whether it is being confirmed by the currency break. Next year, we're going to take a look at crude oil. Crude oil is actually coming to a key level. This 101 to 103 level, as much as it doesn't necessarily correspond with the November and December highs in crude oil, it sort of marks the key Fibonacci retracement zones that would act like support on almost all crude oil selling. And this is a crucial moment, because if crude oil here sells through these zones on the downside, let's say heads to 100 or 98 on the downside, it would certainly damper any chances of a very bullish move, unless it's obviously driven by like a geopolitical event. At this stage, if this bulls can't hold this line, then we will see some crude oil distribution. Next year, I want to take a look at gold futures, and surprisingly, gold futures are holding up a bit. We were identifying that key breakdown move that was occurring below the 1630 level right in here, but the bulls are trying to still save this one on that gold front. At this stage, if there is no follow through selling below 1630, then we could label that as a false start. We still want to see a sustained price action below 1630 to really be bearish down to 1540, 1560. So long as the bulls actually hold it up here, there's always a chance that gold may end up attracting some money as a hedge, and may in fact see a little bit of strength of recovery. So we're far more neutral on gold than we are on some of the other commodities. That brings us to wanting to look at the S&P 500. As always, we start with a weekly chart going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles the market has gone through over those 30 years. In the last year and the year before, we had numerous false starts along that moving average that ended up just being a consolidation. At this stage, we are distinctly bullish and higher on this weekly chart. There's no indication of any new sustained bear market, and so therefore the bigger picture bias still has to recognize this primary uptrend. When we go to the daily charts of the S&P 500, there you can see a much different picture. While we are in the much bigger picture identifying a primary uptrend, one has to recognize that we are long overdue for a market correction. We've been looking for that. We were suggesting that those highs could come in along that 1420, 1440 level for a much needed 5 to 10% market correction. Really, now that we see like a little double top on those, and particularly since we saw a breakdown move now on that jobs number, we now see some potential selling that could come in, even if there's a temporary rally back to let's say the 1390 level on the short term. So long as there's no follow through, we could potentially sell even as low as the 1275 to 1290 on the downside. That doesn't actually have to be where a correction has to go. It could end in the 1320 to 1330 area. We'll mark that off next time as a focal point for our interest, but let's just see whether or not this jobs number data was sufficient to begin that much needed market correction. Just to make some observations on our key intermarket stance. In the bigger picture, we're actually longer term bullish the US dollar, even though on the short term we remain neutral. We would need to see some sort of sustained strength above that 81.50 to 82 area for us to go short term bullish as well as long term bullish on that US dollar. In the same regards, if we saw things like crude oil make that break to 100 or lower, and we saw, let's say, copper break 370 on the downside and wheat not hold the most recent rally, those would be all indications that for us to go short-term bearish commodities as well, particularly if it's confirmed by the US dollar. So that neutral stance we see on the short term could all dynamically change in the upcoming weeks. In the same regard, bonds, if we see any sustained rallying above the 140, 141 level on those 30-year Treasury bonds, we would certainly become even short-term, potentially bullish on bonds. As well, if we don't see an immediate recovery, we may also go short-term bearish stocks. And that would certainly be a big change from what we've seen in the last month in terms of the stances here. But we very well this week could see a lot of those dynamics change. That was your Monday Futures Market Outlook. Thank you for joining me.